My job tonight is to hopefully convince you that the path we're going to take is the one to the left, the brighter path. And in order to do that, I'm going to talk about what happened last year in the markets. I'm going to talk about what I see going forward in this year and beyond. And to do that, I'm going to talk about where we're at in the deleveraging cycle. We're going to look at the US and Canadian economy, specifically the employment market and the housing market, where we're seeing some real progress, and three threats that were really impacting the markets last year and are also going to be a factor in the coming years. Finally, we're going to end up with some things we're doing in portfolios in order to take these into account. Now, looking at the market last year, you can see actually in 2010, we saw strong markets in the US, the S&P 500 up almost 13%. Last year, however, the markets were flat. Now, we did see a nice rally in the fourth quarter. The market was up just over 11%, and that rally continued on into this year. Year ending February, the market was up almost 9%. So we've seen a nice rally. The other thing I would say about the market last year in the US, we had a flat market, but it was extremely volatile. Turning to the Canadian market, again in 2010, you saw a nice return, just over 14%. However, last year in Canada, the S&P 5 or the TSX was down just over 11%. Again, in Canada, we saw a fourth quarter rally, but it wasn't nearly as much as what we saw in the US, just under 3%. And the rally has continued into this year, but again, only up 6%. So slower market returns in Canada, and I think that's indicative of what we're seeing in the Canadian economy versus the US economy. Turning to the bond market, I'm only going to talk about the long end of the bond market tonight. The short end, because of central bank policy keeping rates at 0 or in Canada 1%, there really has been no change in the bond market in Canada. All the action has been in the long end of the curve. So we're looking here at Canadian and US 10-year bonds. And you can see that they started off the year around 3.5%. We ended the year around 2%. In fact, at times we dipped well below that 2% level, which is an extremely low level. So that's a very good market in bonds. And in fact, if you look at market returns in investments during the year, fixed income, mainly long-term government bonds are where you saw good returns, not in stocks, but it was in bonds. Now, why we saw this decline in interest rates was mainly what was happening in the US was the US Federal Reserve was conducting an operation was called Operation Twist. And basically what they were doing is they were taking securities that they held on their own balance sheet that were maturing, and they were reinvesting them on longer term assets. They're trying to drive that interest rate down, in which they were quite successful in. Now, looking at our forecast going forward, one of the things, and this is a slide we've shown for a number of years, we believe presently we're in a long-term secular bear market where you're going to see very flat returns over a number of years, a sort of a trading range. And it's a market that we've seen in past years. In fact, in the 60s, during the Depression and in the early 1900s, we saw a similar market like this. One of the reasons why we think we're in this particular cyclical bear market is that the world is in the process of deleveraging. Basically, consumers and governments have taken on too much debt, and we now have to deleverage. And this is going to provide a headwind for economic growth, which is going to impact the markets. Now, we can use past experiences of other countries in order to see exactly how this deleveraging cycle is going to play out. And using data from McKinsey & Corp, a consulting company, we're going to look at a roadmap based on what happened in Finland and Sweden in the early 1990s. And you can see the pre-crisis stage lasted about 10 years. Economic growth, real growth of 3% was quite robust, normal growth. And you saw this private debt accumulation, whereas the public debt actually was growing, but not that much. Then you had a recession, lasted 1 to 2 years. You had GDP decline 3%. You saw private debt still increase, but at a slower pace. And again, you saw public debt start to increase as the automatic stabilizers like unemployment insurance kicked in the economy. Then you had the next phase, which was the private sector deleveraging, lasted about 4 to 6 years. You had real GDP grow, but very slow, 1% only. And you saw that deleveraging in the private sector down 26%. And you see public debt is actually starting to accelerate. And then finally, the last phase, which is where you had the public sector deleveraging, lasts about 10 years. You had real GDP, a more normalized 3%. You see private debt accumulation go back to a normal trend level, and you saw this public sector debt start to deleverage. We're pretty sure we're in that 4 to 6 period of private debt deleveraging, but it's a long time period. It's 4 to 6 years. And it's going to be a long, grinding process. And to use a sports analogy, it reminds me of a baseball game. In baseball, the game seems to go on, and you never know when it's going to end. It seems like it's never going to end. But the good thing with a baseball game is you can always look at the scoreboard to see exactly where you're at. You can see what inning are you in. And so for tonight, in order to look at where we're at in the deleveraging process, we're going to create our own scoreboard. And we're going to call it Nicola Field. And we're going to look at where we're at in the deleveraging process in personal debt and government debt for both the US and Canada. So let's look, first of all, at household or personal debt in the US. And again, this is a chart that we got from McKinsey & Corp, and it shows that household debt as a percentage of disposable income in the US has been trending higher over the last 50 years. But earlier in this decade, it moved above the trend line, about 30% above the trend line. That's the bad news. But the good news is it's already fallen 15% from its peak. Now, a lot of that is because people have defaulted on their mortgages, which is bad, but it helps speed up the process. And that's one thing that the United States is very good at, is taking their lumps and moving on. Now, according to McKinsey, based on the trend we've seen so far, they think we could be through this deleveraging cycle by mid-2013, so only 1 to 2 years away. And I think this is happening a lot quicker than people think, and this is a positive thing in the US economy, a positive thing that we see happening. And in fact, in the fourth quarter, we actually saw an increase in personal debt for the first time since the financial crisis. So again, positive signs for deleveraging for the US consumer. Now, looking at the Canadian consumer, it's not so positive. That red line, it's showing household debt to personal income in Canada. And you can see that line has continued to move higher. We may be seeing a plateau, but we're not seeing it decline. And it's being considered a major risk for the Canadian economy, something the Bank of Canada talks about all the time. Canadians have to start delever. So let's bring up our scoreboard. Where are we? What inning are we at? We say the US is about in the 6th inning as far as deleveraging personal debt. Canada, we haven't even started, so we're still in the 1st inning. Now let's look at government debt. You can see from this chart, the black line is Canada, the light blue line is the US. Canada has debt to GDP of about 40% versus the US upwards of 80%. In fact, I've seen numbers now that peg the US debt to GDP around over 90%, some up to 100%, depending on what you include. So Canada, much lower debt than the US. Not only that, but if you look at the deficit, so the amount of debt we're accumulating every year, Canada is around 3%, whereas the US is 9.5%, so quite a bit higher. In fact, so Canada has lower debt, not only than the US, but than most countries, such that around the world, Canada is perceived to be a bastion of financial stability. So much so that apparently Iceland is considering using the Canadian dollar as their currency. So in government debt, bring up the scoreboard, we'd say the US deleveraging for the government hasn't even started, and that is an issue and a concern. Canada, we would say we're in the 9th inning, or the game is over. We're actually doing very well. And in fact, the Conservative government has highlighted that they hope to balance the budget in 3 years. So again, very positive for Canada as far as government debt goes. Now let's look at the economy, and specifically US housing. This chart shows existing home sales in the US, and we're starting to see, finally, some signs of life in the US housing market. You can see existing home sales in January up 4.3% versus December, up almost 1% versus last year. Now, prices are still going down, and we may continue to see this happen for a couple more months. But what gives us more comfort that this is going to come to an end is the fact if you look at existing home inventory that's available for sale, it's only 5.6 months. Typically, 6 months shows a balanced market, so we're below that. So again, this is very positive. It gives us some hope that you're going to see prices stop declining in the US. It also could mean that you could start to see more construction, and we did see that in January. You see Building starts in January up almost 10%, which is a very, very strong number. Now, part of that was due to the weather in the U.S. We had a very warm winter, and that helps housing starts. But part of that is also because there's just not a lot of homes for sale in the U.S., and it makes sense to start building again. So again, that's good for the U.S. economy. Canada, not so much. And as far as the housing markets, I'm not going to go into too much detail. John has a lot of slides that go into a little bit more detail on the Canadian housing market. I'm just going to show one chart. It's from The Economist, and what it's showing here is that based on rent and income, Canada is the second most overvalued housing market in the world. So looking at, again, the scoreboard, housing market, U.S., seventh inning, we've made a lot of progress in a short period of time. If we were here last year, we would probably said we're in the first or second inning. Canada, first inning. We haven't seen any correction in the housing market in the U.S. I'm not saying the housing market's going to correct. I'm not saying it's a bubble. It's a different market than what you had in the U.S. But given the valuations we see, it is a concern. Now, turning to the employment market in the U.S., this graph is showing new jobless claims in the U.S. Now, typically, 400,000 is typically perceived to be a level that indicates a healthy employment market. And if you look in March, for the week ending March 3rd, the 4-week average, we're at 355 jobless claims. So that's below that 400,000 level, meaning it's a healthy employment market. If we were to look at non-farm payrolls, which is net job gains per month, you see a healthy trend of increases. We've gone from October, 112,000, to, you can see, December, 200,000, January, 284,000, and finally February, 227,000. Typically, you need about 125 to 150,000 new jobs a month in order to keep up with population growth in the U.S., and we're well above that. And as well, the unemployment rate has gone from 9% in October to 8.3% in February. So again, some really good signs in the U.S. Employment market. Now, one of the questions you want to ask, though, is it sustainable? And in order to answer that question, we have to look at where the jobs are coming from and where we expect new jobs to be coming from. Now, one of the areas we don't have high hopes for, despite what I said about housing starts, is the construction and finance industries. These were part of the bubble, the financial crisis, and we don't expect you're going to get back to these peak levels. Now, where we are seeing new jobs are in retail, leisure, and healthcare. That's good, and we should continue to see that happen. The negative is that these tend to be low-paying jobs, which is not so good. One area, though, we are seeing, which is a bit of a surprise, we are seeing new jobs being created, is in the manufacturing industry. Now, manufacturing, over the last 10 years, the U.S. has lost almost 6 million manufacturing jobs. So it's a bit of a surprise, because you think with low-cost wages in Asia that all of the manufacturing was getting outsourced out of America. It's somewhat surprising that since the recession, in this recovery, the U.S. has created 300,000 new jobs. The key is productivity. As you can see from this chart behind me, the U.S. is one of the most productive countries in the world. They produce more using less people. And if you look at the unit labor costs, they've been able to reduce their unit labor costs by almost 11%, second only to Taiwan. Now, another thing that's helping the manufacturing industry is lower energy prices, specifically lower natural gas prices, and that again helps U.S. manufacturing become more productive. But the oil and gas industry is also a net producer of jobs. New drilling techniques have led to an increase in about 160,000 jobs over the last 5 years. And by the end of the decade, we would expect another 100,000 jobs. If you include, you can multiply that number by 4 if you include related industries. And one of those related industries would be the chemical industry. It was only a couple years ago that the chemical industry was more or less wiped out in North America because of the high feedstock prices. Now, with natural gas prices where they are, you're starting to see companies like Dow Chemical and Westlake Chemical actually create new facilities in North America. So that's a very positive area. So this is where we're seeing some hope that this job gains we're seeing in the U.S. economy is sustainable. In Canada, you can see the red bar there. That is the pre-recession employment levels. And you can see that by the beginning of 2011, we had already gained back all the jobs lost in the recession. That's the good news. Canada did not suffer that deeper recession, and our labor force never suffered as much as you had in the US. In fact, the US still has another 5 million jobs to go before they hit their pre-recession peak. The negative for Canada is the employment gains have slowed. Most of the gains we saw last year were in the first half of the year. In fact, if we were to look at our non-farm payroll numbers, you can see October, we lost 54,000 jobs. November and December were okay, but basically January and February were basically no increase. And the unemployment rate, yes, it did go down in February, but that's only because 37,000 people left the job market, presumably because they couldn't find a job and gave up looking. Why is that happening? Well, it's the same chart we saw for the US. Canada is actually one of the most unproductive countries in the world. In fact, only Italy is worse than Canada when it comes to productivity. And one of the things we worry about with Canada is the high Canadian dollar. There's a very strong correlation between the Canadian dollar and oil prices. So what's good for Alberta is bad for Ontario that has a lot of manufacturing jobs. And so we worry about that discrepancy between East and West. And it's something that if oil keeps going up, is going to continue to weigh on our job growth. So let's look at the scoreboard again. US, we'd say, is in the 5th inning. Canada, we peg in the 7th inning. But I would say the momentum is in the US, the Canadian job growth, and we seem to be stuck in the 7th inning. We can't get those batters out, whereas the US is moving along quite quickly.